I'm Reena Agarwal, Robert McDonough Professor of Finance and Director of the Georgetown Center for Financial Markets and Policy. I'm also the Vice Provost for Georgetown University for all faculty issues. As many of you already know, Georgetown is one of the world's leading academic and research institutions, offering a transformational educational experience that prepares the next generation of global citizens to lead and make a difference in the world. The mission of the Georgetown Center for Financial Markets and Policy is to provide thought leadership for global finance. The center offers innovative, influential, and thoughtful commentary, conducts relevant research that impacts practice and policy. We really believe in excellence in research to impact practice and policy. Okay. Start with excellence in research, but the research should also be relevant to market participants and to policymakers. We host dialogues and conferences involving scholars, practitioners, and policymakers on key financial market issues, just like the event today. Through these activities, the center contributes to an informed, solutions-oriented discussion regarding critical issues faced by global financial markets. We believe it's the responsibility of Georgetown University to provide unbiased analysis. We are not an advocacy group. We have no fight in the game, but we bring rigor to the discussion. We bring research to the discussion that can both be helpful to policymakers and to market participants. And we are located in Washington, DC, which is certainly the nation's capital, but I also think of it as a global capital. And the center has become the go-to place. It has the ability to convene people from business, policy, academia, when important issues need to be resolved. Our events have strong participation from the policy side, from the private sector side, and from academia. We regularly have speakers coming into Georgetown and to the center from the IMF, World Bank, the SEC, CFTC, White House, Capitol Hill, and so on. We've been doing this particular conference on financial markets quality for several years, and it partly is in response to the demand from market participants. Our activities at the center are built around 4 themes. The first one is disruptive innovation, where we cover, and we're becoming even bigger in this area, is FinTech, blockchain, AI, big data, especially applied to the financial markets. The number 2 is responsible investing. Georgetown has been a leader in corporate governance issues. Our faculty have done tremendous research in governance, and that has been, I think, extremely helpful for the markets and for policymakers. So all 3 aspects, the E and the S and the G, and impact investing, they're very natural for us at Georgetown, based on Georgetown's value system. Market structure is our 3rd pillar, and this conference certainly fits into the market structure issues, but obviously overlaps with a lot of other areas. And then the world of alternatives, hedge funds, private equity, commodities, which are playing a bigger and bigger role in our markets, is the 4th area that we work in. Just to give you some examples of what we've been doing, we've conducted studies in partnership with the World Economic Forum on the complex regulatory framework for global FinTech. We've released reports on blockchain and its role in financial inclusion. We've done work on leveraging data in partnership with City Ventures. Our faculty are working on a number of research projects on FinTech, blockchain, and ICOs, issues that are emerging. And Chairman Clayton, many of the questions that our faculty are trying to address are questions that you have raised. And we really think it's our responsibility in academia to address the questions. We have taken the list of questions that you have raised and are trying to address some of those issues, in the whole area of blockchain, ICOs, and FinTech. Hopefully, our in-depth analysis will be able to guide policymakers and market participants. The center is also spearheading courses on FinTech and blockchain, and there's a lot of interest. We have to prepare the next generation of leaders who are well-versed in these issues. So we are offering both in terms of curriculum and extracurricular activities in these new areas that are emerging. Now, sometimes I do worry a little bit that the best and brightest might not be attracted to finance like they were 15 years ago, and we've got to make sure that they see finance as a place where there's innovation. There's a place where they see they can do good, and we want to keep some of the best and brightest in finance for sure. I also want to announce that former SEC Commissioner Mike Piowar, a Georgetown alum, has joined the Center for Financial Markets and Policy as a distinguished policy fellow. We are absolutely delighted to welcome Mike back to the Hilltop. He'll be here with us later today. And I must thank a number of our sponsors and participants today. The list is included in our program. We have BlackRock and Cantor Fitzgerald, the CME Group, FTSE Russell, Emergent Technology, Evercore, Global X, KPMG, MSCI, New York Stock Exchange, NASDAQ, Index IQ, State Street, Invesco, Thomson Hines, CFTC, SEC. And as my colleague John Jacobs would say, there are only two groups in the room today: those who support the center and those who will soon be supporting the center. Right? So we are delighted to have this very impressive group supporting the center, and we appreciate it. John, are you here somewhere? There you are. Many of you already know John Jacobs as Mr. QQQ. John has been part of the center for 3 years now, having had a very long and distinguished career at NASDAQ. We are thrilled to have him with us and part of our team. And today's event is possible largely due to John's effort. And the person that's really responsible for putting this conference together is Jessica Dibfest. Jessica is the assistant director for the center, and I think Jessica is running around somewhere outside. So I want to thank Jessica. I also want to thank our Georgetown McDonough marketing and communications team. They include Chris Cormus, Teresa, Molly, Lauren. Thank you for all your help. And of course, I want to thank my finance faculty colleagues, without whose support this event would not be possible. So we have a great set of speakers, a great set of issues that we'll be addressing throughout the day. And I am going to invite Professor Richard Morrissey to come and introduce the next session. And Richard is going to introduce Chairman Jay Clayton from the SEC and Professor David Roos. So, Richard, thank you.
Thank you, Rena. It's a distinct pleasure and honor to be able to introduce two colleagues and friends, Chairman Clayton and Professor David Roos. Jay comes from a long tradition in his family of public service, including his father, who was a paratrooper in Vietnam, something we should never forget. As chair of the SEC, Jay runs the most important financial and securities regulator in the world. In addition to overseeing the world's largest financial market, Jay is also a voting member of the Financial Stability Board and a representative on the International Organization of Securities Commission, something that is very important to bear in mind since U.S. institutions control approximately 44% of assets under management, despite only having about 4.4% of the world's population. The international financial markets are dominated by U.S. institutions and need the protection of a regulator like the SEC, who has over many, many years provided leadership to the international markets. Before we ask Jay to come up here and answer some questions from Professor Rue, I'm sure he will do so with his customary candor. Everyone in the audience should understand that despite being the chairman of the SEC, the views expressed today here by Chairman Clayton are his personal views and do not reflect the views of the Commission. Hopefully, Jay, I got that disclaimer right. The conversation will be led by Professor David Rue. Dave was the former chairman, CEO, and co-founder of Silver Lake Partners, which was the largest and premier tech buyout firm in the world. So we look forward to hearing more from Jay and David.
So Jay, thank you for joining us on a school day. Especially, I know you were out late trick-or-treating last night. Maybe we could start off for people who aren't finance wonks by having you explain what exactly goes on at the Securities and Exchange Commission. I mean, are you guys exchanging securities? Are you commissioning exchanges? What are you doing over there?
A little bit of the latter, but it's we could take the entire time we have.
Please don't do that.
I'm going to give you a chance to get your questions in. But the breadth of activities that we are responsible for regulating, some on our own, many with other regulators, is really astonishing. It goes from the trading that you see reported on a daily basis to the equity markets, to our debt markets, to markets that are vast but not reported on a daily basis, our private debt and equity markets. And then there's the investor side, and the amount of time we spend protecting investors, whether it's through our inspections group, through our enforcement group, or through just writing rules that better protect investors. But we could go on for some time about the different activities. We haven't even talked about the exchanges, the clearinghouses, all the other things that we look at on a daily basis.
That's great. So I'm always curious. You were fancy lawyer at a big Wall Street firm. How'd you get this job? Did President Trump see your LinkedIn profile, or did you answer a Monster.com ad? Thought, gee, that sounds cool. Well, how did that happen?
I know you're a tech guy.
Yeah.
I hate to tell you, I still don't have a LinkedIn profile.
Opportunity.
Actually, I was not looking for this job, at least not in any kind of active way, perhaps subconsciously. And through a series of events, I guess I became known to the people in the transition team, answered some questions about markets and things that I thought were working well in our markets and things that I thought could improve. But one thing led to another, and now I'm sitting next to you.
So you have been a private sector guy for all of your professional life. You've now made a transition. How long have you been in the job?
18 months.
All right, so a year and a half. Can you give us a little sense of what this public service tour of duty is like? Maybe what's been surprising? How does it compare? Can you give us a little sense of the before and after?
So we touched on one of the most surprising things at the beginning, which is the breadth of activity for which the SEC is responsible. Mm-hmm. In the private sector, we have specialization, competition, et cetera, drives specialization. You become adept at particular things. In contrast, for the SEC, if it develops in the marketplace, we have to cover it. So it's sort of, as innovation drives developments in the marketplace, it's an ever-expanding portfolio. And that is a fascinating thing.
So when you don't just apply for the job. You actually have to show up for a confirmation hearing where people can ask you.
Can you change that?
Where people can ask you absolutely anything, and,
Right.
and typically do. Can you maybe tell us what that was like going through the confirmation process? What was maybe a challenging question you got asked, or maybe something you didn't get asked?
Okay, a couple things on that. I don't think anyone enjoys going through a confirmation process where people can ask anything and you have to think about your, past 52 years of life experiences and what you've done or not done. That said, I was joking. I would not want to see the process change. I think I was better prepared for this job as a result of the process. Getting up to speed, being ready for questions you don't get ahead of time, and thinking about that. So it was a rigorous and I think good experience. Don't want to do it again anytime soon, but I'm glad I went through it. I was thinking about this the other day though, about the questions, because the questions stick in your mind, and the programmatic questions, the policy questions. I'm happy to tell the senators I still think about, the ones that came up. But you know what didn't come up through, and I was just looking at this with the news around the 10-year anniversary of Bitcoin. Crypto assets, cryptocurrencies, ICOs did not come up in my confirmation hearing, which was a little over a year and a half ago. That shows you how quickly issues in our markets develop.
Right. And you've got all these different things going on. How can you dimensionalize for us how big is the SEC? How do you think about it in terms of people, budget, departments?
Sure. It's the SEC. I'll start with the budget and kind of come back to it. The SEC budget, I break it into three categories for thinking about it. It's people, which is close to 80%, kind of tech, which is getting close to 10%, and then the remainder being plant property and equipment. So a substantial portion of the budget is human capital. That human capital is spread out over 11 regional offices and our home office here in DC. 60% of the people in DC, 40% in the regional offices. Our regional offices, in many ways, are eyes and ears on the ground in those regions from an inspections and enforcement standpoint. And the programmatic aspects of the SEC are largely in Washington. Our trading and markets, corporation finance, investment management, those functions, along with our economics unit, are in DC.
And how many people? How many folks are there?
4,600, which is, I love to say this, 4,600 people, and pick any mid-sized financial institution in the U.S., and that one institution has a lot more people than we do.
It's really a tiny number compared to the number of people broadly in finance and firms that you have regulatory oversight for.
Yeah, it's the quality of people at the SEC is really high, and if you want to do like analysis, the fact that 4,600 people have the kind of coverage and impact and respect, there's only one answer: they must be pretty high quality people.
But how do you know that? I mean, I'm not doubting, but how do you think about the effectiveness and productivity of your organization? At the end of the year, does somebody sit down and do a performance review for Jay Clayton, or how do you think about what your team has gotten done? Are there a set of objectives? Are there, it's just another great year, nothing blew up? I mean, how do you think about it?
So there's you think about it in all those ways, right?
Yeah.
But there are the usual management tools, and we just went through a process of producing a strategic plan for the next 5 years. That strategic plan has a number of goals, and we're developing the metrics. We will use those. But can I go on a little bit here? Is that
Of course.
on this
Yeah,
issue?
you're the star.
Yeah. Okay. So, organizations. You've run a lot of organizations, invested in a lot of organizations. I think they have to have a paradigm for decision making, and we have corporate governance and interest of shareholders and other stakeholders. The SEC is no different. And when I got there, there's the statutory mission for the SEC. You protect investors, make sure markets are running efficiently and fairly, and that we're facilitating capital formation. Those are 3 goals. But how do you make decisions? And I kind of talked to the people there and all the different divisions, and I came up with a paradigm that works for me, which is if we look at someone who's going to be in our markets for the long time, someone who's investing $500 a month in their 40s because they want to have a good retirement, what's in their best interest? Now, capital formation is in their interest because the economy needs to grow. Efficiency is in their interest because the less drag on their investments, the more they have at the end of the day, right? Investor protection is clearly in their interest. But if we look at it through what matters to them, that's a good way to make decisions. And it kind of came organically because I think that's how people at the SEC have been making decisions for a long time.
Well, that's an interesting contrast, because I think most people, when they think about the SEC, are thinking that the SEC is really spending all its time looking at what's going on Wall Street. It's kind of focused on big firms, big banks. But as you talk about it, what does the SEC do for small investors and small businesses? Give us that contrast between the public view that it's really all about a few big firms in New York and a couple in LA versus what you just described.
So we do spend a lot of time focused on those big firms because they have influence in the marketplace. And if you're going to regulate a marketplace well, you need to regulate the people who have influence over it.
And have a recent history of misbehavior.
Yeah. No, that's and what do we learn from the past, and what do we apply in the future? Absolutely.
Yeah.
But we also think about let's go to the investor side of it. If we have a regulatory ecosystem where that investor I talked about, the drag on their investment every year goes from 1%, or as we say, 100 bips, to 50 bips over the course of their investment life cycle. I was out at the Pentagon yesterday talking to people about financial readiness. The question at the end of people's careers is how long is my money going to last? That 50 bips over a 20, 25-year investment horizon is either more dollars a month in your retirement or more years where you're comfortable you're not going to run out of money. That's a big deal.
Sure.
So if we can, through transparency, through efficiency, through competition, drive the drag on investment for the individual investor down, that's a good thing. On the small business side, access to capital is so important, and there are fixed and variable costs associated with the access to capital. It's pretty simple math. The fixed costs for a smaller business are much more significant than they are for a larger business. If we can reduce that fixed cost of getting capital for those smaller businesses, that's a big deal.
So in that regard, maybe you could comment on the fact that when earlier in my career, if you go back to the mid-90s, we had 8,000 public companies in the United States. Today, I think we're 3,700 or so, under 4,000. So it's dropped by half. And so it looks like there are fewer companies to invest in, fewer choices. Is that a good thing? Is that something that we should be worried about?
I don't think it's a good thing, and I think it's something we should be worried about.
Are you doing anything about it?
Trying. No, but it's fascinating. Think about it. Think about it. If I'd love, we're here at Georgetown. People study these things. What is that data telling us? And there are some things people say, it's the cost of going public. But what are the ramifications of that? Now, are we going to get into a world where retail investors, the investment opportunities that are available to them, are shrinking in number and in type? Because I think if you look at those numbers, you're a numbers guy, you will tell me that what comes out of that is probably that the companies that are public are now much more mature overall than they used to be, which means you probably have fewer growth companies
Less
in
growth,
the public markets.
less dynamic companies coming to the market. Right.
Fewer, and our economy is still growing.
Economy's doing fine.
Economy's doing fine. So where's the growth capital? It's somewhere else, and it's a place that retail investors don't have access to it. At least don't have access to it without, as I said, substantial drag. Instead of 100 bips or 50 bips, how about 500 bips for a retail investor to get into that?
Yeah.
It's not really the dynamic that you want.
Right. Maybe shifting away from that for a minute, could you talk a little bit about, you've only got so many people, so much resources, and one of the things you're responsible for is, trying to ward away bad behavior. Mm-hmm. And you can do it in two ways. You can warn people away from, here are things that we don't want you to do, tell that story. Mm-hmm. Or you can go bonk people on the head and prosecute people for somebody who's done something, right? Prevention versus cure. How do you decide how much time is spent kind of warding people away versus prosecuting somebody for bad behavior?
It's not an either or.
You got to do both.
You got to do both, and you have to use those two different types of resources, plus one that's sort of I would say quasi in the middle, which is inspections. You got to use those to their greatest effect. So what types of matters is bopping people on the head going to have the greatest effect?
Right.
What types of matters is saying, we don't like that. If you don't clean it up, you're going to get bopped on the head. And then what types of matters are we saying, hey, show us what you're doing because we're watching.
Right.
And those are, but you allocate your resources in each of those areas as best you can. And we are being very transparent about what we're doing. So in our inspections group, we put out risk alerts and we put out exam priorities. We say, here are things that we're seeing that trouble us from a risk perspective for our financial intermediaries and financial utilities, and here are things we're going to inspect for because we want to know that you're doing them right. And then on the enforcement side, I think our enforcement directors have been very good about setting out priorities.
Could you talk a little bit in that, kind of maybe following on there, a little bit about the difference between the way the SEC operates here versus what's going on in other major financial centers, Britain, EU, Japan, China, the kind of the big other markets, a little compare and contrast perhaps?
So I'm going to be a little bit of a patriot here because I think the way we have approached regulation over the years has in many ways informed and to some extent driven the way our industrialized colleagues have approached regulation. And the reason is it's worked really well. Okay, I think Professor Morrissey mentioned some of this, but these are stark statistics. We have 4.4% of the world population. We have 65 of the largest 100 public companies are U.S.-centric, U.S.-listed companies. Assets under management, are around 40, 50% here in the United States. If you're a regulator in those other jurisdictions, you're looking here and say, what are they doing right? And look, global economic growth is good for all of us. I'm happy to have a dialogue. I'm happy if they're doing things right to think about it. So we do exchange ideas. We exchange ideas around regulation. We particularly exchange ideas around systemic risks. But in large part, securities regulation in industrialized economies is pretty similar. It's based on high-quality numbers, transparency, and in high-quality numbers, there's no substitute for audit quality. and there's no substitute for transparency. And then, at the end of the day, confidence. Do people have confidence in the way the markets are working?
If audit quality is so important, how come we only have 4 auditors?
I don't know, you tell me.
What I was asking is there's really only 4 big auditing firms in the world. All of them do a very good job, but it's an unusual thing that there would only be 4 when there was recently, 20 years ago or 25 years ago, 8. So if you're a company choosing, there are many fewer choices out there.
There are fewer choices out there, and I will just say, as globalization has increased, and firms have become more global, and the complexity involved in auditing has increased.
For sure. Yeah.
So scale is important to be able to provide high-quality audits for large companies.
Yeah. What's the scale, the transparency, the depth of the markets here in the U.S. are envy of the world. What's the risk? What is it that we need to guard against that keeps things that way? I mean, what do you worry about in the shower, commute in the work, in the morning?
I ask
the whack-a-mole game that
I ask myself that question multiple times a day. Are there things that we're missing that would undermine confidence, that would result in prices reacting incredibly negatively quickly? Those types of questions. And what have we learned from the past is informative, but each new crisis is different from the ones of the past.
Well, you mentioned earlier that it was surprising that you didn't get asked about cryptocurrencies, even because when that was happening, it hadn't really blown up in the US yet, but it was already the rage in Korea. It was big in China. Silicon Valley was already bubbling with it. Now it sort of burst onto the scene more prominently.
Yeah. To be fair, at that time, it had not burst onto the retail scene.
Right.
And shortly after I got into the position at the SEC, the crypto asset attractiveness burst onto the retail scene.
Mm-hmm. And so how you have something brand new like that? How do you form a task force? Do you hire a consultant? You get some brand new thing, all of a sudden some big storm cloud comes in. How do you deal with that? There probably wasn't a crypto office down the hall. You could go knock on the door and talk to that person. How do you?
So we're here.
How do you spin it up?
It's actually I haven't. So we're here at Georgetown University. One of the things I don't do while I'm in this job is teach. But for years I taught law school at a competing, maybe slightly better.
Another institution.
another institution, and one close to my heart. And I taught law school, and what I would say is, look, when you're taking a law school exam, and it took me a while to figure this out, when you're taking a law school exam or when you're presented with a problem, start with 2 things. Who's your client, and what's the law? So if you look at what was happening in the crypto space and the exposure of retail investors, who's our client at the SEC? Our client are those investors, and what's the law? And you know what? Turns out we had a pretty good set of laws for raising capital. We managed to create a $19 trillion economy with the most vibrant capital markets in the world, following those laws. And so the idea was, do those laws apply to this new space? My view is they apply pretty darn well. And we set about making sure people understood how they apply. Let's tell them how they apply, and then let's apply them. And we're in the process of applying them.
So your view is new technology, but kind of known issue, because there's law that kind of deals with that. How about where we think about new technology, maybe where you think about cyber threats more, not cryptocurrency, but cyber threats more generally, because one of the things that's happened in the last 30 or 40 years, the flip side of efficiency is it is now
Data dependency.
all completely data dependent and computerized, right? The whole system is now fully automated. And so what role does the SEC play in helping exchanges or companies manage that cyber threat?
So I think a couple of things, and you characterized it exactly correctly, and the dean talked about it in the introduction. Big data, the importance of data driving efficiency, our use of data to improve trade. Well, data reliance becomes data dependence, and then therefore protection of data is extremely important. Kind of happened fast over sort of the life cycle of our economy and markets. And so what is the SEC? In large part, a disclosure-based organization. And we have 4,000 public companies. One of the things to do is to say, hey, 4,000 public companies, tell us how data dependent you are. Actually, tell us, but tell the public, tell your shareholders how data dependent you are and what you're doing to protect that data, to have an environment that's resilient. Let's do the same thing with our market utilities, with our exchanges, with our clearinghouses. Tell us how data dependent you are. Tell us what you're doing to make sure that you have resiliency built into your systems. And then we have a better. We already know we have an issue. Now we hopefully have a better handle on the contours of that issue and how to deal with it. And I think we're largely in that phase.
So part of it is, as with many things, transparency, discussion, shining a light on it. Part of it is saying, hey, and if it doesn't work, you got to have a backup plan for how to make it work, kind of the resiliency and durability
and one of the
part of things.
And one of the great things about, many great things about transparency is, there's peer-to-peer comparison.
Right.
I want to do business with the person who has better data protection.
Sure. I want to be in a better bank.
Yeah.
I want my money to be safer. I want my data to be safer. Yeah. I've always been curious, what happens when somebody or some organization misbehaves, a fine becomes necessary, and somebody gets fined $50 million or $100 million or $1 billion. Where's that money go? Is that, you guys keeping a piece of that, or is that is that part of your budget? This is like getting stuff for a traffic ticket in a small town. What's the deal?
The money goes different places, and to be very serious, I think to the extent our retail investors have been harmed, we should do what we can to get the money back to them as efficiently as possible. It does end up in the Treasury on occasion or more than occasion, because.
But it's not bigger bonuses for SEC employees.
Not that I know of.
Not that you know. No. Okay.
But it's a great question, because fines. We use fines for deterrent effect. Say, look, we use fines to say you're a wrongdoer. You deserve to be fined. We're telling the rest of the marketplace, if you do this, you're going to get fined, deter bad conduct in the future. But we should also use our remedial powers, our ability to require monetary payments, and our ability to require behavioral adjustments to future effect, to either compensating harmed investors or ensuring that they're better served in the future.
And in that sense, how do you think about, oftentimes, like, you find a company, but it's not really the miscreants who are getting fined. It's the company, which is owned by a group of shareholders. And so the shareholders, in a sense, get dinged, but the bad behavior, or the people who conducted the bad behavior, not always punished in the same way. How do you distinguish between the people and the company, I guess is the question.
No, look, and to frame it in sort of a law school kind of way, or a business school kind of way, there's the argument at the one end of the spectrum, which is you shouldn't fine companies because it's the shareholders' money, and you're really punishing shareholders for misconduct. And then there's the other end, which is, the company is an entity, and you should apply the same deterrent principles to an entity that you would to an individual. Like most things, life is somewhere in between. We should think about the shareholders' interests, but you have to use the tools available to you, and corporate fines are sometimes the only tools that are available to you to deter bad conduct going forward, and shine a light on bad conduct.
Yeah, very helpful. Could you talk a little bit about your background? I know this is the last question. This is exactly what you feared would happen.
Yeah. And you've been so nice.
I've been so nice. You seem like a nice guy. How did you end up as a lawyer?
Guys,
there's a form of atonement being paid now, of course, with public service, but
nice guys like you need help too.
yeah, no, for sure. But so, give us just a little bit of background. I think people are always interested to understand. You grew up where what did mom and dad do, and how did you get to law school, and how did you stay a lawyer? Just give us a little bit of.
Okay, I'll give it a shot. Grew up in central Pennsylvania, kind of rural central Pennsylvania through the 6th grade. Then moved to the suburbs, landing for high school outside of Philadelphia, where I met my wife and a number of great and continuing friends. Went off to college, mostly as an athlete, not as a student. Ended up liking college, which was a shock to many. Did fine. Studied engineering, loved it. Had an opportunity to go, I think we share this, to go to Cambridge to study economics. Studied economics. Thought about being an academic, and wound up back at Penn, and landed in the law school. Thought that was an interesting place. Went to work for a law firm, didn't think I'd stay.
Test drive.
Test drive, I've always been since college, been very curious about markets. And actually working at a corporate law firm was a really good way to get exposure to markets and how they operate. And that curiosity continued to be satisfied for 20 years. And I can tell you that curiosity is more than satisfied in my current job.
Well, Jay, as you may know, the Georgetown Finance Department is well known for its research prowess and quantitative rigor. And turns out that we've run a small piece of research where we have examined
I thought the last question was the hardest question.
No. We have examined all of the Trump administration senior appointees, done a careful analysis of background, and determined that you have the lowest golf index of all appointees, which leads us to believe that you have probably played golf with the president. And we would like to know, or more accurately, I would like to know, how good a golfer he is.
So you're getting.
You thought you were going to get away without a tough question.
You're actually getting 2 answers with 1 question.
2 answers with one question.
Yes, I have played golf with the president, and by any measure, he's a very good golfer.
I won't ask you who won. Rena, I understand that there are some questions that have been submitted by members of the Georgetown community, and that you're going to pose those on their behalf.
Yep, thank you. So actually, my questions and the questions from the Georgetown community are going to be a little bit easier than some of the questions that Dave asked you. Following up...
A low bar.
Following up on the discussion about public companies, and are you concerned that the number of public companies is going down, and you obviously said that you're concerned from the retail investors' point of view. The question from one of our faculty members is, one of the many causes of the decline, it has to do with the increasing cost of compliance. And the specific question is, 10Ks are now twice as long as before. What is the SEC doing to reduce compliance costs that can help and enhance capital formation?
Good question and well framed, because the words many is in there. There are many factors driving this decline in the number of public companies. Costs of becoming and staying a public company are one of them. I think let's recognize what a real issue there is, which is we have a compliance system that's largely built for very large companies. Not a surprise. We now have some very large companies, public companies, that are very important in our marketplace, and you would build a compliance system and a reporting system that reflected that size and complexity. We should probably ask ourselves, and we are asking ourselves this question, does that compliance system work for companies that are 1/100th the size or 1/1000th the size, don't have the same geographic? A one-size-fits-all compliance system that's based on a global, complex company, we need to think about that.
So how do you think about the request that recently BlackRock and other firms have put to the exchanges? If you become a public company, then within 7 years, in terms of multiple voting systems at the company, whose responsibility is it to watch out on these governance issues? Is it the exchanges? Is it the MSCIs and the FTSE Russells of the world? Is it the SEC, or everybody plays a role?
So historically, multiple parties have played a role in the governance system of public companies, including most prominently our states. But we all play a role. Part of the role is transparency. How do you govern your company? Explain it to your shareholders. What are the laws? How do you apply those laws to the way you govern? Exchanges have criteria for listing. If you're going to become a public company that has the good housekeeping seal of approval that you're a listed company, what are the standards that you need to apply in terms of governance? And now we have new entrants on governance. Asset managers are asking about governance. Index providers are asking about governance. So it's an issue with many interested parties.
Let me go to the second question here, which is the EU dropped its quarterly reporting requirement with no apparent harm to market quality. And we understand the SEC is now looking at it. What criteria will you use to decide whether to modify the current US quarterly reporting requirements?
So let's take a step back. The issue of quarterly reporting has been raised, and it was raised by the president. The question that a lot of people are asking is, are we managing our public companies too much for the short term? That's a broader question. The question of quarterly reporting, it's complicated. We have a system that's been largely built on quarterly reporting. We have investors that thirst for information. In many jurisdictions, quarterly reporting is not required, yet companies report quarterly. I think there are things that we can do to improve our periodic reporting system and provide higher quality information with less of a burden. But the question of short-termism is a much broader question than quarterly reporting.
Thank you. The next question is sort of a much broader question. So based on your experience as a US financial regulator, you're obviously very well acquainted with the many shortcomings of our current system. If Congress asked you for advice on some key ways to overhaul the financial regulatory system, what would you recommend?
So sticking to my world, capital markets, and not getting into other people's areas of banking and whatnot, there are some shortcomings. Our job is to try and find them and fix them. One thing that I would love to see is the perspective that while there are shortcomings, this is a pretty incredible system that has been built. Let's take a look at what we've done, rigorously and continually evaluate it and try to fix the shortcomings, but not forget how important it is to our economy and to the world economy. I mean, it's hard to overstate the importance of a well-functioning U.S. capital market system beyond our borders. I'll give you just one thing: prices. Having confidence in price signals is an incredibly important thing for ordering your economic affairs. Our markets provide reliable price signals around the world. That is an extremely important thing. If you can't rely on prices, you can't invest for the long term. You can't order your affairs. And we've managed to create a system that, with some flaws, some problems, some things that we should take very seriously, has provided those price signals for quite a long time.
Is our financial regulatory system too complex? Do we have way too many regulatory bodies, CFTC and SEC and the Federal Reserve Board and OCC and FDIC, and we can go on. And after the 2008 crisis, the idea was to consolidate, but we've actually created even more regulatory agencies. And I completely understand that our system is complex.
Let me give you a pragmatic answer to that. I'm not spending a whole lot of time redesigning the regulatory structure of the United States. I am spending a lot of time making sure we work better together, or as well as we possibly can.
Okay, great. Chairman, I want to ask you, for the benefit of the students in the audience, any advice on how they should be thinking about their careers? And as I mentioned, I think students who are going into finance, they're really passionate about finance, but they want to be involved in innovation. They want to be involved in doing good. And certainly from my point of view, if you're in finance, you can be doing good. And there's a lot of innovation happening. What advice would you give to our young people?
Wow. I think it's embodied in your question, and that is follow your passion. If you're passionate about something, follow it, find out a way to satisfy it, or never satisfy it, but keep it burning, following your passion. And in finance and markets, there are lots of places where bringing what we have in large part here in the United States to bear can have a huge effect. Actually, I'm going to give Professor Rue a lot of credit here. He said something to me a while ago, which is ability is widely distributed, but opportunity exists in pockets, if you think about it geographically. If you want to be passionate about something in finance, create more places where ability and opportunity match.